Latin word ORA means the edge where the land and the sea meet. So for ORA Fund Managers, it means the border between caution and innovation. ORA Fund Managers are specialist investment managers dedicated to tax-efficient investments and a risk-focused investment process. Now, here to give us some insight into their investment strategy is Eugene Goosen, who is Chief Investment Officer at ORA Fund Managers. Hi, Eugene.
Hi.
We've just had a fascinating discussion with Glenn Silverman. He's been in the US and Europe talking about markets there. What's your perspective of markets at the moment? We've talked about this ongoing emergency, this ongoing crisis. Markets generally have been nervous and volatile, people waiting and seeing. What's your perspective of what's been going on?
I think we must start and take a big breather and just look at the market and think back what we experienced in the previous crash, and just be very careful that we don't get too over pessimistic. I mean, it's a fact that Europe is in a total mess. There's not going to be any growth, and that there are extreme risks in the environment, and that the whole European scenario is driving things like Glenn clearly said, our currency. If we look at the States, I don't think the States is in such a mess. It's not in a great state. I don't believe the States is moving into a recession next year. I think on the contrary, we're going to see a hovering GDP growth of maybe anything between 1.5% and 2.5% over the next 2-3 years. China slowing down, yeah, sure. I think the slight growth that we're going to get from the States will improve exports from China to some extent. I think Japan will support it to some extent. So, obviously China is in the process of relaxing the fiscal and monetary management stance. So I think China, not too wonderful, but good enough. It's most probably going to keep growing above 7.5% over the next 2 to 3 years. And if you stand back and say, where are the risks and what are the local domestic drivers? I mean, it is the European markets, and in the world that we live in, we've got to focus on the S&P 500 and say, from a momentum perspective, where's that going? From a valuation perspective, how do we see it over the next year or so? And take that to the local market.
Eugene,
South African rand, it is always going to be a problem in a risky environment. The guys use the rand as a trading proxy. But if we see some stabilization, we've seen strong retracement in commodity prices, we're most probably going to see the rand slightly stronger than weaker. I'm not a weak rand.
Just Eugene, I'm a bull amongst bulls. Sorry, I didn't mean to interrupt you. I'm a bull amongst bulls. And I like to look at the bright side of things, but I can't help but be worried about Europe and about the consequences of ongoing issues in Greece and what an exit would mean for the euro. Why are you more optimistic? You know, how do you see this unfolding?
No, David, I'm not optimistic about Europe at all. It's a mess. It's a total mess. But the point is, I think the numbers have discounted this mess through and through. If you look at basic GDP consumption across the world and we break it up into the pockets, into the various pockets, Europe is not going to contribute much. And yes, it impacts substantially on us, but how much will it draw out of us even more? Are we going to see substantial contraction in Europe? I don't think so. I think we're seeing negligible slowdowns now, 0.5%, maybe a little bit more. The risk is the banking sector and to what extent the banking sector will be supported. If we look back into the crash and we just take the Lehman's experience, if we can avoid a Lehman's experience in Europe, then things will be fine. Will an exit from the euro area from Greece cause a Lehman's effect? I don't think so. I think the market has discounted Greece exiting. Actually, I think the market has discounted Greece to some extent defaulting. I think the effect of Greece in the broader picture is nothing. The effect of Italy and Spain is substantial, especially Italy, because it's a big contributor to European GDP. And the banking system there is very sensitive, not profitable at all, and there's liquidity issues. Can liquidity issues be addressed? It can. Liquidity management in the banking sector is not that difficult. I mean, the European Central Bank had their 3-year liquidity injection into the banking system at the end of last year, and they're most probably going to do more. And that will stabilize the banks. It's exactly what the States did in the crash. They just opened the taps, allowed liquidity, had dollar swaps across the globe. So I'm really worried about Europe, but I don't think that's the alpha and the omega. We're looking at it and we stop living and stop investing because of that. We're actually starting to see, should look for buying opportunities at this stage.
Yeah, Eugene, in the light of what you were saying, I mean, where do you look for value? And what about your asset allocation strategy, given what you've just said? You're saying it's tough out there, Europe's in a mess, but doesn't mean you stop buying the investments that you want.
Yeah, I think if we focus on the domestic market first, and we say, you've got a choice. You can put your money in the bank at 5.5% and get taxed on it. So at the end of the day, you just get, say, 3.5% out. You're not going to beat inflation. You can go into bonds. You get, say, 7 and a bit out of it on the longer end, which is maybe not too bad, but I think there's a little bit upside risk there. You can go into equities and buy the market now at forward P's of, I don't know, 9 times earnings. Let's say earnings growth is flat for the next year and not 10, 12% up as the market expects. At least the potential there is slightly better. So I would definitely be overweight equities. I think the other asset class in the domestic market that we must just look at is property. What kind of dividend growth do one expect out of property? The market is currently discounting growth of around 5, maybe 5.5%. I think the market is underestimating it. I think the retail sales slackness that we've seen in the market is a little bit over pessimistic. I think we're going to see slight improvement there. And I think if I contrast property to bonds and cash, I'll most probably start overweighting property in the domestic market. And then if you take it from a foreign perspective, yes, one's got to be careful playing the currencies. I think you shouldn't get too over-optimistic about the emerging market currencies. You're not going to make huge amounts of money out of it. I would tilt my portfolio still on the defensive multinationals. I mean, if we just use the S&P 500 as a proxy, well-diversified cash flows in the top 50, 100 shares, I would rather tilt that way than international bonds. Although if you look at the credit markets, international credit markets, your BBB Treasury spread has shot out quite a lot. And there's slowly but surely opportunities presenting themselves in the foreign credit markets as well. Although I'm not overly optimistic, we all know that at some stage over the next 2-3 years,
I'm
going to stop you there, Eugene. David's got one last question.
Eugene, you paint a very nice picture, and one that fills me with a bit of hope. Glenn was quite optimistic on resources. Do you share his views and think against the kind of background that you're seeing?
I do to some extent, David. I think if we look at commodity prices, and I just look at things like platinum, which I know there's still a little bit of downside, coal, maybe thermal coal more than and iron ore as an example. I think the retracement in those commodity prices was severe, and the ratings that we're seeing on Anglo's, Billiton, Kumba, Exxaro, these kind of stocks is really getting very attractive. Even in this industrial action doldrums, I'm starting to look at companies like Implats. At 13, 14 times PE, it's not unattractive. Platinum price is at really, really low levels. There is oversupply in the market. We know the Europeans drive that in essence, but slowly but surely, China is starting to utilize more platinum than what they did 3-4 years ago. The States is expanding to some extent. You know, it's not the diesel-centric engines in those regions, but it is expanding. So, yeah, I think that's an area where I would rather slowly but surely starting to go overweight.